beautiful friends, hope you are doing well. Welcome to the second episode of our futures trading course. If you've not seen the first episode, it's going to be in the description of this video. Just check the description, you're going to see it there. And after watching it, you can come back to this one. Of course, you might want to start with this one. You will still understand it, but I would highly recommend you go to the first one. In this episode, we're going to look at the following jargons that are used in futures trading, and we're going to be doing something really unique. We are going to be trying to understand each of them as they apply to the cross and isolated. But these are like the basic things you should understand that will help you manage your risks properly and understand what you are doing in the futures market. Before I continue, I would like to point out that after this second episode, we are going to go live to summarize the concepts we've covered in both episode 1 and this episode. So you are welcome to come with your questions. If you do not understand what I've been teaching so far, or you need some clarifications, just pen down your questions, okay? Make sure you have a book and a pen to write, okay? So if you want to know when we will go live, make sure you subscribe to this channel, turn on your notification bell, and most importantly, check the description of this video to join my Telegram channel so you do not miss any update. Okay, and please repeating that, make sure to join my Telegram channel. That's how you're going to know when we would go live. Okay, so you can come with your questions, okay, so that we can clarify some of these things in case you do not understand. All right, so in futures trading, what do we mean when we use the word account balance? What is this? Well, account balance is the money you've deposited into your futures trading account. So this right here is my account balance. All right, so whether you are on the cross margin mode or you are on the isolated margin mode, your account balance remains your account balance. Okay, I've got about 50 USDT here. Okay, so my account balance is 50 on cross. If I decide to go to isolated, my account balance will still be 50 USD. The next jargon or concept, okay, is a margin. What do we mean when we use the word margin, and how does it apply to both cross and isolated margin modes? So to explain this, let's start with cross. Okay, the cross margin mode. You can see cross is selected here. Now your margin is the amount of money from your account balance, from this 50 USD, okay, that you go into a trade with. In the first episode of this course, I told you to always use percentages of your account balance. That way you would properly manage your risk. So say I decide to go into a trade with 10% of this, that would be 10% of 50 is 5, right? So 5 USD would be my margin. If I decide to go with 5% of 50 USD is 2.5 US dollars, right? So my margin will be 2.5 US dollars. Okay, that's on cross mode. If I were to be on isolated, let's select isolated. Now I've got isolated selected. All right, so my margin is also the percentage of my account balance I want to go into a trade with. All right, so if I go into a trade with 10% of this, that means I'm going into the trade with 5 USD, so my margin will be 5 USD. All right, and if I decide to go into a trade with just 5% of this, that means my margin will be 2.5 US dollars. Now here is the difference. All right, in isolated, if I decide to go into a trade with just 5% of this, that means I am only risking that 5%. The remaining balance, around 47 US dollars, 47 point, shouldn't that be 47.5 US dollars? All right, yeah, that's what it should be. That amount will not be involved in the trade. So the only amount I would be risking will be the amount that I committed to the trade, and that's 2.5 US dollars. But in cross margin, all right, in cross margin mode, all right, your entire balance would be at risk, right? Even though, let's say we're using 5%, which is 2.5 US dollars, all right? So even though you're using 2.5 US dollars as your margin, your entire account balance is going to be at risk because you are using cross margin mode. That's the difference between the two modes. All right, to help you understand what I've been saying so far, you want to start trading. You've got 50 US dollars in your trading account. This is your account balance. Say you are applying a leverage of 10x and you are using a margin of 5%. Remember what I told you margin is. Margin is the amount from your account balance you want to enter a trade with. So let's say you want to go into a trade with 5% of your account balance. So 5% of your account balance is like saying 5 over 100 times your account balance, which is 50 over 1, right? So if you solve this on your calculator, 5 times 50 and you divide that by 100, you will get 2.5 US dollars. So this 2.5 US dollars is your margin, all right? So what is your position size? Your position size is this amount here multiplied by your leverage, all right? Multiplied by that leverage. So our position size is equal to 25 US dollars. So 25 US dollars is your position size. So this is how you can calculate your position size for your trade, all right? Know the percentage of your account balance you want to use. In this case, 5%, all right? And after that, multiply it by your leverage to get your position size. So on Bybit, where would you key in your position size? Your position size will be keyed in here. Can you see it? I've got it already put here, 25. So 25 is my position size. This is the leverage applied. And then of course I am on cross margin mode, all right? And then what would I have to do next? Either long or short. I'm going to come back to long and shorting later, right? But let's say I am in isolated. So let's switch this to isolated. Click on that and go to isolated. On isolated margin mode, all right, I would still have 25 US dollars as my position size because I still have 50 USD here, 10x, and I'm using 5% of this. So 25 USD will be my position size. Position size is the notional value of your trade, all right? The value of the trade you want to take. But the interesting thing here is that under isolated, you would have to remove your margin from this. So what I'm saying is that since we've got 50 USD in our account balance, 50 USD in our account balance, we would need to take away 2.5, all right? So we need to take away our margin. So you need to take away this, and that's gonna give us about 47.5 USD. So 47.5 USD, this amount right here represents, so let's move this out of the way. So that amount represents the balance on your account that is not at risk. So when you are in isolated, the margin is the only thing at risk. I hope this makes sense. So now let's look at another important jargon. This time we're looking at margin balance. This guy right here. So what is margin balance? Well, margin balance depends on the mode you are on. Okay, so let's start with isolated margin. Well, remember for this trade we had 50 USD, leverage 10, margin was 5%. So when we did the calculation, 5% of 5% of this, all right, it gave us 2.5 US dollars as our margin, right? This was our margin. So now on isolated margin mode, your margin balance would be this margin, all right, plus any profits you're making. Let's say you open a trade on isolated mode and you're making profits, all right? So this margin plus the profits you're making. So margin balance is your initial margin, all right, the margin you put into this trade, right? 50 US dollars account balance, you're using 5% of it, that's $2.5. This is your initial margin, right? So the margin you put into the trade plus the profits you're making, or minus the losses you're making, that's what we call margin balance, all right? I hope this makes sense. But if you're on cross margin mode, your margin balance has a different meaning, all right? And what is the meaning? Well, in cross margin mode, your margin balance is simply your entire account balance or your available equity, all right, plus the profits you're making or minus the losses you are making, all right? So let's make this a little bit understandable. So let's go back to the isolated margin. You enter the trade, all right, and this is your margin. So let's say you're losing $0.5, all right? So you are losing $0.5. So if we take it out of this, if we remove it from there, you're gonna have how much? You're gonna have just $2. So your margin balance will be $2 because you are losing $5 from your margin. So your margin balance is gonna be $2. But for cross, if you are on cross mode, it is going to look different. So if you're on cross mode, it is going to be your entire account balance. Remember our account balance is 50. So it is going to be 50 US dollars. Take away how much you are losing. So let's say you are losing $5, all right? So your margin balance is going to be 45 US dollars. So you see, in cross margin, your entire account balance is at risk. But in isolated margin, just the margin you put into the trade. In isolated, all right, just the margin you took from here and put into the trade, that's the only thing that is at risk. Once you get liquidated, the remaining balance is still safe. But in cross margin, your entire account balance is at risk. All right, so now let's look at something also important, and this time we're going to talk about realized losses and unrealized losses. All right, so what is realized, or what do we mean when we say realized losses? These are losses that have been applied to your account. Unrealized losses are losses that have not been applied to your account. What do I mean? So you are on a trade, all right, let's start with isolated. You are on a trade and you've got 2.5 US dollars on your account, and you are losing, as before, say you are losing $0.5. So this money here is unrealized. That's an unrealized loss because you are losing it and because the trade is still on. Let's say you're making a profit of 0.5 US dollars. If we add 0.5 to this, that will be what? That will give us about $3, right? That will give us $3. So your unrealized profit would be 0.5 because that's what you are making while the trade is still on. What about realized? Well, realized losses are losses that have been applied to your account. I'll say that again. Realized losses are losses that have been applied to your account. So where can realized losses come from? They can come from trading fees, all right? So far, we've covered margin balance, realized losses or gains, unrealized losses or gains. So what about equity or equity? Equity is simply the current value of your account. All right. So what do I mean by that? So you have an account balance of $50. All right. So let's say you are making losses. All right. And you are losing $10. So $50 is your account balance. You are losing $10 for example. So $10 is your unrealized loss. All right. So let's say there is a realized loss of $5. So we take away $5 also. $5 removed. So that's like removing a total of $15 from your trading account. So that is going to give us a balance of what? That's going to give us a balance of 45 USD. All right. So 45 USD would be your equity, right? So your equity is the current value of your account after you have taken away realized losses and unrealized losses if you are making losses. But if you're making gains, your equity will be your account balance plus your unrealized gains. Okay, so let's say you're making a profit of $10, so this will now be plus $10. And let's say you've got some realized profits. All right, maybe you've been receiving funding, all right, from funding fees of $5. So you add everything, so this should give us about 65 US. So that means you are your equity is 65 US. So what is maintenance margin? Maintenance margin is the minimum amount that must be in your account for your position to keep running. All right, the minimum amount of money that must be in your account for your position to keep running. You just don't rush to an exchange and start trading assets. You must know the margin requirement for that asset you want to trade. If you want to trade BTC USDT, if you want to trade Ethereum USDT, whatever asset you want to trade, what is the margin requirement for that asset you want to trade on that exchange? So margin requirement is always expressed as a percentage. Okay, typically expressed as a percentage. So on exchanges you will see something like you will see this it means margin, maintenance margin. And then you will see also I'm going to show you this on Bybit. You will see also MMR is maintenance margin rate. So let's say you have an account balance of $50, leverage is 10x, margin is this. So let's say your margin rate is 1%. All right, so let's say the margin rate is 1%. So you're going to first find your position size, and your position size is what? Okay, our position size is going to be 10 times 5% of this. 5% of this we found it earlier to be 2.5 times 10, which is 25. So our position size is $25 US. All right, so your maintenance margin is typically calculated on your position size. So let's say we have a maintenance margin of 1%. So 1% of this is 0.5 USD. So your maintenance margin will be 0. Let me have the US dollar symbol. 0.25. This will be the maintenance margin. So this maintenance margin here simply means that your account must not fall to or below this. Your account should not fall to or below this. If it falls to or below this, you're going to get a margin call and you're going to get liquidated. Okay, so that's what maintenance margin is. It is the minimum amount of money that must be maintained on your account to keep your trades open. All right, so when you are running at a loss, you should know what your maintenance margin is, because the moment your balance drops to that, you are going to lose your trade. So let me give you an example. All right, so let's say you are on cross. You are on cross, right? Remember, on cross your entire account balance is at risk. So you're on cross and your maintenance margin is 0.25. all right, so what this means is if you have an unrealized loss of say $10, so if we take away 10 from here, that means you would have a margin balance of 40. All right, so let me take that there. So $50 from your account, take away $10, that is gonna give us $40. So you will still have a margin balance of $40. So is this $40 below this or equal to this? The answer is no. So on cross, provided that your unrealized losses do not get your account down to this or below this, your trade will still keep running. I'll say that again. Your unrealized losses, if you take them away from your account and it doesn't go below this or equal to this, your trade will keep running. You will not be liquidated. But this is not the case for isolated. For isolated, remember I told you, for isolated, only the margin you put into the trade is at risk. So for isolated, let me erase all of this so you would understand what I'm saying. So on isolated, we still have these details: account balance 50, leverage 10x, margin 5%. So that means your position size is 25 US dollars. All right, and your margin, all right, is 2.5 US dollars. So if you lose, say, so if you're making a loss of 0.5 US dollars, let's say you're making a loss of 0.5 US dollars, that means you are losing it from this amount, all right, from your margin. So that means you still have 2 US dollars available, all right, as your margin balance. So the question is, if a maintenance margin rate of 1% is applied, maintenance margin rate of 1% is applied on your position size. If it is applied on this 25, remember we calculated it before, and that was 0.25 US dollars. So that means this is equal to 0.25 US dollars. So when you're losing 0.5 from your margin, that will give you a margin balance of $2. Is this lower than this? Well, the answer is no. Well, you will still be in the trade. All right, you will only be kicked out of the trade the moment your margin, all right, drops to this or below this, and that will be when price goes like around 9% of your position size. So if price goes against you by around 9% or 10% of your position size, all right, 10% of this is what? 10% of 2 or your position size, $25 is 2.5, which is equal to your margin. You'll be kicked out of the trade or you'll be liquidated. Okay, so this is how it applies to isolated margin. So now let me show you these things I've been talking about. Okay, so let's take a trade, and I am going to put, we have $50, 10x isolated. All right, so let me put 25 is our position size as we've been calculating. All right, so let me long, so I'm gonna go long on this trade. So go long. All right, so read these details, just click on confirm. So watch, I'm just taking a random trade. All right, so watch what is going on right now. You can see it is in green. I am up by 0.14%, so I'm making some profit by going along. This is my liquidation price. I explained this in my previous video. All right, if this trade market price drops to this, all right, I am gonna get liquidated. Why? Because I longed. Long means I'm predicting the price to keep going up. But if it decides to start dropping till it gets to this, I'll be kicked out of this market. But here is what I want to show you. All of the things I'll be explaining to you. If I click on this trade, just click on it. All right, it is going to show me some of these things I've been explaining. All right, so it says position size 12. Can you see it? Position size is 12. So you might be wondering, how is position size 12? But you said position size is 25. Well, let's go back. Well, if you multiply the quantity, that 12 represents the quantity of the Visual USDT token that I got. So if I multiply 12 by my entry price, that should give you my position size, all right, which I have there. So let's go back again. So here is my entry price. That's the price you enter the market. Market price, this is like the current market price. Estimated liquidation price, okay, I explained it. Once the price drops to this, I'll be liquidated. Liquidated means this platform, Bybit, is going to close this trade. All right. Value is the value of the trade, the position size, all right, of the trade I opened, the notional value of the trade I opened, all right, which is same as 12 times my entry price. 12 times my entry price gives me this. Now you can see some of those terminologies I was using earlier. Unrealized profit and loss. If you look closely here, you can see that I am down by negative 0.0324 USDT. This is my unrealized loss. Why is it unrealized? Because this trade is still going on. It has not yet been applied or settled on my account balance. All right, and remember I am on isolated. All right, and realized profit and loss. So this is how much I am losing now. Okay, all right, and this has been settled on my account. So this is realized, is already settled on my account. 0.0133 USDT. And notice it's negative and it is in red to show that I have lost this amount. And remember, I explained to you where realized losses come from. They come from trading fees, they come from partial closure of trades, or funding fees. All right. And then what else do we have here? We have IM here stands for initial margin. Initial margin is like the initial amount of money I committed into this trade, and we've been calculating it since. All right, we used the position size of 25, and then we used a margin of 2.5. You can see this is 2.4, slight difference, and this difference is because of these fees right here. All right, it should be 2.5 exactly. And then can you see it? I told you this earlier. Means maintenance margin. The maintenance margin for this trade is 0.2062 USDT. Now, before you trade any asset, know the maintenance margin. All right, check it out on the platform you are trading. All right, because maintenance margin depends on the asset you're trading, and it depends on the risk tiers of the assets involved. All right, so make sure to check those out. So what does this really mean? What this means is that since I am on isolated margin, all right, my margin balance must not drop to this or below this. The moment it drops to or below this, I'll be kicked out of this trade. So remember, my initial margin is 2.4 USDT. So when this right here drops to this amount or below this because of unrealized losses, all right, then I'm gonna be kicked out of this trade. So these are very, very, very important jargons, things that people do not pay attention to, things they neglect, but they are really, really very important, like the ABCDs of trading. These things will help you understand what you are doing on any platform. All right, and some of you have asked me to teach this on Mexi, some have asked me to do it on Binance. It doesn't matter the platform. All right, these things are similar. All right, just understand it on one platform, you should understand it on other platforms. It is pretty much like playing the piano. If you can play a Yamaha product, you should be able to play another product. It's like driving. If you can drive a Mercedes Benz, you should be able to drive a Toyota Camry. All right, so that's it. And then of course you can see in this trade I went long and I am on isolated margin mode. So in summary, some people prefer using isolated because they know that just the amount they choose from here to put into the trade is what is at risk. For example, if this trade goes wrong, this money is still safe. All right, the balance is still safe. The only money that will be lost will be the money committed to this trade. But in cross, if this trade goes wrong, the entire balance would be at risk. But again, I am going to close this. All right, so let's close this trade. You can see I've longed the trade, and what most traders do, advanced traders do, is they just pay attention to their liquidation price. All right, they can so push this liquidation price far away that it will be almost impossible to liquidate them. And how do you do that? Use smaller percentages of your account. All right, so you can start with 5% of your account on a 10x leverage, or maybe you go with 2.5% on 10x leverage. And so this is what we're going to draw the curtains. But before that, I talked about funding rate. All right, remember I told you if funding rate is positive, all right, what it means is that those long in the market will pay those shorting, right? So if it is positive, it's an indication for you to short the market because you're going to be receiving funding from those who longed the market. But if here starts reading negative, what it means is if you're shorting the market, you are going to have to be paying funding. All right, you're going to be paying funding to those long in the market. So that means if you are shorting the market when here is negative, it is not good for you. It means you should rather be long in the market, so that you'll be receiving funding from those shorting the market. Okay, so if you've got any questions, keep them ready. Make sure you're subscribed to my YouTube channel, and of course join our Telegram channel. We are going live soon, and we're gonna summarize these things we've been talking about in episode 1 and 2, and you can also ask your questions. And then of course after that we're going to look at fundamental analysis, and then we're going to dive into technical analysis. Make sure you stay tuned, share this free course with your friends, and let's go.